Are you thinking about day trading the S&P 500 futures contract? Here's a couple things to understand first before you pull that trigger. Number one, first and foremost, futures are a highly leveraged asset class. What does that mean? Let me put it in perspective for you. A $10 move on a stock is worth $10. Okay? Pretty simple to understand. A $10 move on the S&P 500 futures contract is worth $500 per contract. So know that going in before you start buying and selling contracts. Number two, grasp the macro view. Understand the long-term direction of where the S&P 500 has been and where it likely wants to go. It's very important to start from that long-term view first. Number three, understand the speed of the market. There's a couple ways to measure it. I measure it in two ways, using the VIX and using an ATR. The VIX usually does a nice job of giving you a broad vision or a broad sense of how fast the market is going. So if the VIX is at a 12, 13, 14, 15, somewhere in that range, it's a nice mid-range speed. During high volatility times, it can get up to the 40s, 50s, and 60s, and 70s and beyond. And that's a little bit outside my window of what I like to trade in. Know how to measure speed in the marketplace and know what your preferences are for the speed of the market. Number four, peek at the inverse markets. Take a look at those as well. Know what the bonds are doing, know what the dollar is doing, and even some of the reverse ETFs that are out there. Go look those up and see what they are doing as well. Number five, red hot news. This is a must for anybody who is looking to trade during the cash session of the S&P 500 contract. Know when there is red hot news. Use a news aggregator. I use forexfactory.com. It's a great website that you can filter out for all of the red hot news that's going on in just the U.S. market alone. And what you're going to want to do is plot those on your calendar so you know when news is about to drop. Okay, so for instance, you don't want to be in a short-term day trade when Jerome Powell steps up to the microphone and announces an interest rate change. You're going to lose, and very quickly. So you're going to want to know those times specifically. Number six, volume. Is there volume in the marketplace? Are you trading during the high probability, high liquidity times, which is the cash session? And lastly, risk management. Risk is a function of your account balance. Okay, so I'm going to walk through an example with you. Let's say you have a $50,000 account. Okay, and let's say you're willing to risk 1% of your account balance per trade. Okay, that means you're willing to risk $500 per trade. And then let's say on the other side of that, you're willing or you're looking for a 2-to-1 risk reward ratio, right? So you're seeking $1,000 and you're willing to risk $500 to do so. Okay, so that's how you start your risk management plan. Work from that and work backwards. Make sure you understand what your risk management plan is and how you can manage it. If you like this and you want access to the tools, check out Ninjacators Fast Track with the link below.